Assalamualaikum viewers, we are Bisma Kareem and Anas Yahya, and in this video we will explore the 1992 scam titled Harshad Mehta's Stock Market Marriage, a Tale of Deceit. We will delve into how the entire banking system suffered losses of 3,000 to 4,000 crores due to Harshad Mehta's scam, and how this scam continued for 3 years and what its effects were. In India, two markets operated in parallel. Number one, equity market. This is basically the stock exchange market where people buy and sell shares of companies, essentially owning a piece of a company's value. Number two, debt securities markets. This includes government and corporate bonds and is also known as the debt market or credit market. In 1992, there were many brokers operating in the equity market, and on the other hand, the debt market had fewer brokers, and they were required to obtain licenses from the Reserve Bank of India. Government securities were traded in the interbank market, where both buyers and sellers were banks. This parallel market structure created significant arbitrage opportunities which Harshad Mehta exploited. Harshad Mehta's journey began as a salesperson at New India Insurance Company. He saw the potential for profit in the stock market. By 1981, he had built connections and gained knowledge while working at stock brokerage firms. In 3 years, he became a broker at the Bombay Stock Exchange, and in 1982 to 1983 founded Grow More Assets Management Company with his brother. At that time, Reserve Bank of India required banks to invest in government securities to maintain a certain weekly quota. Banks that fell short had to pay a penalty to the Reserve Bank of India, so they often borrowed from each other in a short-term loan instrument known as a ready forward deal. The collateral for these deals was government securities. Harshad Mehta approached borrowing banks and requested checks issued in his name instead of the lender's banks. He promised to supply bonds and asked for more time. He then approached the lending banks, offering them extra interest in exchange for additional time. Now the question is, why did banks easily issue checks in Harshad Mehta's name? Harshad Mehta had positioned himself as a reliable broker who could deliver government securities when needed. He acted as a house broker, satisfying the needs of both buyers and sellers in the market. Harshad Mehta's profit in this scheme came from investing heavily in the stock market with the funds he received from banks. He influenced the stock prices by injecting large sums of money into certain shares, which attracted public attention and further investments, inflating share prices. But now question is, how Harshad Mehta paid the interest on borrowed funds while investing in the stock market? Harshad Mehta had a vast network of lenders and borrower banks. He managed deals with banks, closed them at times, and when funds ran low, liquidated shares. This continuous rotation of money between banks and the stock market was his expertise. Greed ultimately led to Harshad Mehta's downfall. He persuaded Bank of Crores and Metropolitan Cooperative Bank to issue fake bank receipts that were not backed by government securities, rendering them essentially worthless. Bank receipts are basically referred to financial documents or instruments issued to banks. He then used these fake receipts to close deals with borrowing banks. As a result, the stock market boomed with some stock values soaring. For instance, ECC Limited's value surged from 200 rupees to 9,000 rupees. Other stocks like Reliance, Starlit, Copper, BPL, Apollo Tyres, and Tata Steel also experienced significant price increases. Harshad Mehta's portfolio swelled to around 1,000 crore. Everything went well until investigative journalist Suchita Dalal exposed Harshad Mehta's activities in the Times of India. This marked the beginning of his downfall. Bank officials grew concerned and lending banks started demanding the return of their funds. But when the scam was revealed, the stock market crashed as it was essentially a bubble. Harshad Mehta could not return the borrowed money due to the market's extreme decline. CBI stepped in and charged him with 70 fraud cases. This entire scam resulted in the stock market incurring losses of around 4,000 crores. For the sake of justice, the government banned the sale of these shares for 1 year, affecting not only brokers but innocent investors worldwide, causing significant losses as share values plummeted.
Assalamu alaikum. This is Anasya here, and now I'm explaining the impacts. The biggest impact was initially triggered by Harshad Mehta. The immediate impact of the scam was a sharp fall in share prices. The index fell from 4,500 to 2,500, representing a loss of rupees 1,000 crores in market capitalization. Though one may be tempted to blame the steep decline in prices on the scam, we think that the reason for this fall was not the scam directly. If we see it technically, the scam just resulted in the withdrawal of about rupees 3,500 crores from market, which for a market of the size of rupees 2,50,000 crores at an index level of 4,500 is a very small amount and therefore should have little impact on the prices. There were, however, two major reasons for the fall, both related to the government's knee jerk response to the scam. The first was the phenomenon of tainted shares created panic in the market. Tainted shares are basically the shares involved in the scam became worthless due to the government actions. And the second was the perceived slowdown of the reforms process, which destroyed the very foundation on which the boom was based. We now take a look at both of these factors. The government's liberalization policies came under severe criticism after the scam, with Harshad Mehta and others being described as the products of these policies. Liberalization policy is basically the policy that reduces government regulations to encourage economic growth through free market principles. Bound to the political pressures and bad press it received during the scam. The liberalization policies were put on hold for a while by the government. The Securities Exchange Board of India SEB postponed sectioning private sector mutual funds. Implementation of some aspects of the Narasimham Committee recommendations on the banking system was also delayed. Some question marks arose regarding privatization as the chairman of the committee looking into the ended up in jail on charges of involvement in the scam. The much talked about entry of foreign pension funds and mutual funds became more remote than ever. The euro issues planned by several Indian companies were delayed since the ability of Indian companies to raise equity capital in world markets was severely compromised. This scam of 1992 of Harshit Mehta sent shockwaves through the heart of the securities market. His actions triggered a catastrophic collapse of the Bombay Stock Exchange, leaving investors reeling as they watched legs and legs of rupees vanish in the blink of an eye. The BSE index plummeted from a robust 4,500 points to a mere 2,500, symbolizing a staggering loss of over rupees 1000 billion in market capitalization. It was a breathtaking free fall, the likes of which the stock market had never witnessed before. Investor confidence hit an all time low. However, every dark cloud has a silver lining. This scandal catalyzed a complete overhaul of the stock transaction system and introduced state of the art online security measures. The year 1995 saw the enactment of the Securities Laws Amendments Act, which significantly expanded the regulatory powers and jurisdiction of the Securities and Exchange Board of India. These sweeping stock market reforms marked a monumental step toward addressing the vulnerabilities in the system.